Hey everybody, in today's video I'm going to show you how you can analyze an income statement to determine which line items are better or worse than in the prior year period. In this example, I've got Walgreens' latest financials for Q1 fiscal 2024 compared to Q1 fiscal 2023. Now, one of the problems with analyzing an income statement is, you can't just take the current period value minus the prior year period, because the problem is, in a lot of cases, revenues and expenses need to be treated differently. Because in this case, sales were up 3.3 billion. That's a good thing. That's a positive thing. But in this example, cost of sales also increased by 3.5 billion. That's not a good thing, right? So we want to highlight and call to attention that this was not a good change, right, in terms of analyzing the income statement. And once we summarize these better or worse values, we can put them into a waterfall chart to help visualize them as well. So there's a lot of advantages of framing it in a way where it's a lot easier to track, because if we just looked at this, we might be tempted to think the positives are good, the negatives are bad, but that doesn't tell us whether they're actually better or worse. So what you might be tempted to do is say, okay, for the revenue items, you're just going to take the current minus the previous, but for the expenses you do the reverse. But that doesn't also work well as well, just because you've got things like income tax benefit, right? You've got other income and expenses, right? So it's sometimes it can be mixed in. You've got gains and losses or income items sprinkled throughout the statement. So instead of doing that, what I'd suggest doing is creating an extra column or using another field to specify, whether you're expecting an increase or a decrease, and whether an increase would be good or whether a decrease would be better. So let's say if it's better or worse, then I'm going to say, okay, I'm going to specify whether an increase would be better or a decrease would be better. So in the case of sales, we want that to increase. If it's cost of sales, which is an expense, we want that to decrease. Gross profit should increase. Selling, general, and administrative expenses, that should decrease because that's an expense. We want that to be lower. Equity earnings, this is another earnings item, so that should be an increase. An operating loss, now even though this is a subtotal, because it's a loss, we want our loss to decrease. For other expenses and income, since this is other income, right, negative would be an expense, we want this to actually increase. So this can be a little bit tricky. It takes a little time to figure out whether you want it to actually go up or to go down. Here we're talking about, again, another loss. In this case, we're going to say it's a decrease. An interest expense, we want that to decrease. Loss, again, loss before income tax benefit, that's going to be a decrease. We always want our losses to decrease. The income tax benefit, that's a positive impact on the bottom line, so we want that to increase. Post-tax earnings from other equity investments, again, also increase. Net loss, we want that to decrease. So now that we've got that classifications throughout, what I can do now is adjust my formula to say, okay, now if this is equal to an increase, then I can take this value and subtract the prior year period. If it's not, then I'm going to take the prior year period value and subtract the current year period. And so now our calculations will look a little bit different. Now in this case, we've got sales being a positive 3.3 billion, but now cost of sales, which is expense, we have a negative 3.5. So that tells us it's worse. So now we can have another formula here to say, okay, if this is greater than 0, then B for better or W for worse. And now we can classify it as such. Sometimes on financial statements or reports, you might see B and in parentheses W, that means better or worse. So now we can actually see that, okay, cost of sales was worse. It was 3.5 billion, going the wrong direction. Gross profit was down. Selling, general, and admin, that went down sharply from 13.158 billion down to 6.851 billion. So that's a good improvement, a good reduction. Equity earnings reduced, but again, we wanted that to increase, so that's actually worse. The operating loss shrank from 6.1 just to 39 million, so that's a big improvement. So that's something that we want to say is better. Other income and expenses. Okay, we went from an income to an expense. So we had other income, but now that turned into an expense. So that's worse. We had a loss, so our loss shrank. That's better. Again, a positive. Interest expense decline. That's a good thing. Loss before income tax benefit. Again, our loss shrank, which is a good thing. Our income tax benefit, however, shrank. So that's a bad thing. Post-tax earnings from equity method investments. Again, that's an income item, and that decreases. So that's worse. Overall, net loss improved by 3.5 billion. So that's a positive. So you can see by putting this in the context of positives and negatives, it's a lot easier to see whether we did better or worse in certain areas, and a lot easier to summarize this. Now, the next thing I'm going to do is put this into a waterfall chart to now visualize these values. So I'm just going to select all this, hit Control C and Control Shift V to paste as values. Now I don't need these ones anymore because I've got the better or worse values. So I'm going to use that. And now when you plot this on a waterfall chart, you want to get rid of any subtotals like gross profit, because what we want to do is effectively tell the story of how we got from this to this. We don't want to include the subtotals because we're effectively going to be double counting at that point. So operating loss, again, that's a total. Loss before interest and income tax benefit, again, remove that. Loss before income tax benefit, that's another subtotal. Let's remove that. Then we've got net loss. We want to remove that as well because we don't need to see that. Ultimately, the goal is to explain the difference in the net loss. So the total difference was 3.5 billion. If we tally these up, it should match the same thing. So if it does, that means we know all the changes are accounted for, and we can now explain how we got from last year's net loss of 3.8 billion to this year's loss of just 278 million. So now that I've got that confirmed, everything's accounted for, let's put this into a waterfall chart. So I'm going to select this, go to Insert, Select Chart, and it detects that one of the ones I may want to use is a waterfall chart, which is correct. So I hit OK, open this up, and now let's expand this so it's nice and big so we can see exactly what happened. So one thing you may want to do with a waterfall chart is just to make it abundantly clear that what the positives are and what the worst values are, is adjust the legend here. So if I select, let's say, just want to select the increases here, so double click on this. There we go. And then let's change this to green. And worst ones, decreases, would be negative. Oh, got to be careful sometimes selecting too much here. There we go. So now we can see that, between sales and cost of sales, sales was a positive increase of $3.3 billion, but that was more than offset by an increase in cost of sales of 3.5. So here our cumulative effect, we're right around zero. So sales and cost of sales basically canceled one another out, and actually we're in a worse position after the increase in cost of sales. But, selling, general, and admin, that was reduced by $6.3 billion. So now we can see the cumulative effect here. We're up over $6 billion. So if we had no other expenses at this point, we'd be up over $6 billion compared to the previous year in terms of the bottom line. But then there was $11 million less in equity earnings. There was other income expense, which went $1.2 billion in the opposite direction. So at this point, we can see our net change is less than $5 billion. So here we're over 6, but after this change brought us down to under $5 billion. Then we had another big swing here, an income tax benefit of almost $1.4 billion. So after this, we're down to around, between 3 and 4 billion, which is we are about $3.5 billion improvement. So this boosted us up, this brought us down, this gave us a bigger boost, a tiny reduction here, a big one here, and another big one here. And so, but just by looking at this chart, we can visually point at the three main items that drove Walgreens' improvement in the most recent quarter. One was a reduction in SG&A, then an increase in other expenses, and a reduction in the income tax benefits. So just by looking at those three items, we can visually see where the company did better or worse in its financials. So that's the big advantage of putting this data in terms of better or worse, because it makes it a lot easier to analyze the income statement, because like I mentioned, you've got sales and gains all sprinkled in within the financials. So it's not as easy just saying, sales is going to be in one direction, everything else in the other direction, because it's going to be a bit more complex than that, depending on whether you're dealing with gains and losses, other income. So it's important to just spend a minute or two just making sure you got the classification right, that whether you want whether an increase would be better or worse. So for things that that would be better if they increased, put an increase, and if they'd be worse if it's better if they decreased, then we put decrease in there. So that way we can set up our formulas around there to say, okay, if it's an increase, then we want the current period value to be higher than the prior year period. Otherwise, we're going to do the opposite and take this value and subtract this one, because if it's higher than the prior period, that means that it reduced, it decreased, right? And a decrease, if it happens, and we put decrease here, then that would be positive. Like in the case of cost of sales, this actually increased. We didn't get an increase here, so we say that's worse. So once you set that up, it'll be a lot easier to analyze income statements and put them in the context of waterfall charts, because that makes it a whole lot easier for visually analyzing it and can save you a lot of time in your analysis. So that's a wrap for this video. If you liked it, please make sure to leave a like and subscribe for more. Thanks for watching.